When you're buying something new, you want to make sure it's worth your money. Here at Which, we put thousands of products to the test every single year and give you the results so you can make informed choices. So to ensure you're buying the right product for you, why not get yourself a Which Full Access annual subscription for half the usual price? Right now you can get 50% off the usual price for a Which Full Access subscription, which gives you access to all of our product reviews, as well as access to the Ask Which service, where you can chat to us online for personalised one-to-one buying advice on any product we've tested. Not only that, but you'll also be able to use the Which app, and you'll get the Which magazine delivered direct to your door every month. So, to get a Which Full Access annual subscription for just £49.50, just head to join.which.co.uk. That's join.which.co.uk for 50% off the usual price. Offer ends on the 31st of July.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm Rob Lilly-Jones in for Lucia Ariano, and here's what's coming up this week.
I think you'll get a sweeter deal if you put a bit of legwork in, because the best rates, as ever, if you want to access those, they're normally used as an incentive by banks or building societies to attract customers.
The situation should be better than it is, but based on our research, we found that even though the base rate has been locked at 5.25% since last August, which is a fairly long time, our analysis shows that many banks are actually offering customers savings rates well below this. And in fact, since the start of this year, average rates across the market have tended to either stagnate or outright decline.
This week on the podcast, we're asking why so many of us feel shortchanged by our banks. With interest rates remaining at 5.25% for the time being, why are so many banks reluctant to pass on this level of interest to savers? Our recent investigation found huge gaps exist between the best and worst savings rates on the market. So what's going on? Well, to help us understand all that, we're joined by Which senior writer Josh Wilson and Claire Barrett, the presenter of the FT's Money Clinic podcast. Hello both.
Hi.
Hi there.
It is brilliant to have you both here. Now, Claire, I'll be with you in a second, but first, Josh, it was your investigation that inspired today's episode, and we'll get into the numbers shortly. First, though, can you help explain why rates are so high at the moment? It's something we've covered a few times here on the podcast, but obviously always worth a reminder about what's going on.
Yeah, so we're just coming out of a period of high inflation. And when inflation is high, the Bank of England usually raises the base rate. And they do this in an attempt to bring inflation back under control. The theory goes that as interest rates rise, borrowing gets more expensive and consumers tend to spend less and save more. And what this does is, in turn, this hopefully brings inflation down. And a higher base rate also encourages the retail banks to offer better savings rates for their customers.
Now, Claire, you and your colleagues at the FT, you're among the best placed to answer this next question. So on interest rates, Josh has just explained sort of how we got here. What's going to happen next? The £1 million, more than multi-million pound, $1 billion question, I suppose.
Well, quite. Well, at the beginning of the year, shock horror, the Bank of England actually provided some guidance that turned out to be largely correct. This phrase, higher for longer, the chief economist Hugh Pill even used a mountainous metaphor. He said, this is going to be like Table Mountain. Interest rates have gone up very fast and they're going to stay flat for a long time. And indeed, that is what happened. Now, we may get a rate cut in August, but markets think it's unlikely. They think the first one is going to happen in September when the Monetary Policy Committee of the bank meets, and it's not going to be very large, 0.25%, so a quarter of a percentage point, and perhaps another one later this year if inflation stays below that 2% rate, as Josh was explaining. But the mortgage market has already anticipated those moves. So if you're looking around for a mortgage deal, the best rate that you'll get on a 5-year fix at the time of recording this show is about to go under that crucial 4% mark. So the mortgage market is already moving, thinking that rates are coming down. But then we've been here before, and it's taken longer than we think. So further into 2025, yes, financial markets are expecting rates to go lower, but the further out you go, the harder it gets to predict. And I think the big worry for me is what's going to happen to inflation if A, Labour put through these big public sector pay rises that they're talking about, because that's going to give people more money in their pockets, potentially create more demand. What will happen if the price of food refuses to go down? We've had a lot of climate-related problems this year. I mean, if you've bought olive oil in a supermarket recently, I mean, it's more expensive than vodka.
Well, you mentioned mortgages before. You basically have to take out a mortgage to buy a bottle of olive oil at this stage.
Yeah, and this is all down to the harvest failing, climate change, more than 1 year impacting the crops, and it's happening for everything. We've had stories in the FT in the last week about the price of coffee shooting up, the price of cocoa beans, and this is all being pushed up higher by traders who are buying into futures and thinking, well, this is getting more expensive, it's going to be a good investment. Poor old consumer. And then, of course, there's the question of geopolitics. What goes on in the world? We've got a war in Europe, in Ukraine. We've got this huge presidential election. So still a lot to play for, but in the very near term at least, we would hope to see a small cut.
I did say it was a hard question to answer, and you did a really good job.
Oh, thank you.
Well, like you said, there are still so many things that are still unknown that will, of course, contribute to that rate potentially changing one way or the other. At the moment, of course, as we said, if we talk short term, rates remain at that 5.25% mark. While this is bad news for those looking to borrow, especially those remortgaging, as I am next year, when, fingers crossed, maybe the rates will have dropped ever so slightly. On the flip side of that, though, does this mean for savers, Claire, are we getting a sweeter deal as a result?
I think you'll get a sweeter deal if you put a bit of legwork in.
Okay.
Because the best rates, as ever, if you want to access those, they're normally used as an incentive by banks or building societies to attract customers. So I should say, if you are lucky enough, of course, to have some money that you can put aside to save, because this is a huge luxury at the moment. All of the financial resilience indicators that we're looking at are saying, yes, people have got a little bit more to save now on average coming out of the pandemic. But there are some significant groups who still haven't seen any post-pandemic bounce in their living standards. Single parents are a really big one. Single people. I did a column about the single tax a couple of weeks ago in the FT, and my goodness, I had a roaring response to that. But also people who work freelance have a lumpier income, and of course people who are renting a property versus people who are buying, because the pace of rents going up is far outstripping inflation still. So for those groups of people, very hard to save. For those of us who are lucky enough to have some money, then the least we could do is make a bit more effort to find somewhere to earn some extra interest.
And I'm sure as today's episode goes on, you will tell us where we should be placing that effort when it comes to
I certainly shall.
our savings a little bit later on, so stay tuned for that. So, Josh, rates are high. We are saving more, although, as Claire's just outlined there, not all of us are, of course, able to save more for various reasons. But the reason we're talking about this on today's show is that the banks aren't necessarily offering the highest rates that they maybe could do, are they?
Yeah, so that's quite right. Even though
I enjoyed the sigh in your voice, you were like, "Yes, unfortunately, that isn't right." But that just kind of, exemplifies the situation.
Exactly. The situation should be better than it is, but based on our research, we found that even though the base rate has been locked at 5.25% since last August, which is a fairly long time, our analysis shows that many banks are actually offering customers savings rates well below this. And in fact, since the start of this year, average rates across the market have tended to either stagnate or outright declined.
Now, is this just instant access accounts, or are fixed rate accounts being impacted as well?
So this is a particular problem for instant access accounts. The market average for those is currently 3.1%, which is well below the base rate, whereas the average for 1 year fixed accounts, on the other hand, is 4.7% at the time of recording. This is still below the base rate, but it's much closer.
So when we talk about these numbers, what are the differences between the type of deals you're going to get, the type of rates you're going to get from the major banks to building societies to challenger banks? Who's going to give you a better deal?
Yeah, this is where things start to look really dire for the major high street banks, because our analysis shows them doing much worse than the market average and much worse than their competitors when it comes to instant access accounts that don't have opening restrictions. For example, in June, the average challenger bank was offering 3.3%. The average building society was offering slightly less, 2.9%. But the major high street banks were lagging well behind, with an average instant access account paying just 1.6%. To give you some specific examples, examples, Lloyd's Easy Saver account offers just 1.4% at the moment, and Halifax's Everyday Saver pays just 1.45%. This is really paltry stuff.
That is really, really incredible, actually, when you illustrate it with numbers like that. I mean, Claire, I'm going to bring you in here. Listeners may have heard you, I think, sigh at one point there when Josh was running through the numbers. Does any of this surprise you?
It doesn't surprise me, but inertia has always been a feature of all financial services markets. And even with the consumer duty, I think it's definitely made banks prod more and say, are you aware that your great interest deal is coming to an end in a month, 2 weeks, 1 week, you can switch, here are the alternatives. But it's still up to us as consumers, if we are lucky enough to have cash savings, to think, well, where could we get some more money for them? But one other dynamic that's feeding into all of this, of course, is tax. Now, tax on savings interest, it was introduced around 15 years ago, but nobody's really had to pay it since that time because there hasn't been interest on savings. It's been at these negligible levels, matching those worst accounts, 1%. So if you are somebody who earns more than £50,000, if you've got more than 10 grand in a cash savings account, the level of interest you're going to get on those top paying 5% sort of accounts, that's going to use up all of your personal savings allowance. If you earn any more interest over the top of that, you're going to have to pay income tax on it at your highest marginal rate. If you are in the 45% club, as I call it, somebody who earns over £125,000, in England certainly, Scotland it's a bit less, you don't have any headroom on the interest that you're allowed to earn tax-free. You have to pay tax on all of it. So even if you're getting that top 5% rate, after you've paid the tax, you may as well cut it in half. So just looking at the savings accounts that banks offer doesn't come into it. You have to think of cleverer places to put your cash, whether that's in a cash ISA, which we're going to come on to later for the higher earners, they really are coming into their own, or even in non-standard products like premium bonds, where the way things are structured, if you win a prize, the prize is tax-free, but there's no guarantee that you'll get the interest.
We do love premium bonds here at Which. I know there's plenty of stuff that you can read online, which.co.uk. Josh, you're smiling at the mention of premium bonds.
Yeah, it's something that I've had to write about a few times in the past. I know our members, they really love NS&I.
But for good reason, as Claire's just mentioned there. Is one of the reasons why so many people are suffering with rates at the lower end of the spectrum, so with the high street banks that we've mentioned, the ones offering those lower rates, is one of the reasons loyalty? Stats show that many of us are kind of remaining with one bank potentially for our whole adult life, which maybe that was just the thing that you did. That was the thing that your parents, your grandparents did. But many of us are still guilty of that.
Yeah, I mean, I think it's the perceived hassle factor of changing bank. Now, I've switched banks and I have multiple bank accounts because I like to know what all the banks are doing and how good their apps are, because I think for consumers nowadays, how good your banking app is, and my goodness, there's a huge variation of difference. That, on a day-to-day basis, might be a more valuable function for you than being able to get, say, 7% interest on a regular saver, which is something that lots of the high street accounts are offering. Now, there are some people who are going to think, well, I haven't got enough cash savings to be bothered with moving. There's not enough interest at stake. There might be some people who think, well, if I earn more interest, I'm going to get taxed on it, so I'm not going to bother about that. But then there may also be other groups of customers who think, well, I know I can get a higher percentage point interest on one of these app-based banks, but I've never heard of them. And I think that and the sort of fact that you've got to open accounts digitally, be able to scan in passports, there are some customers who are quite happy to do that. I opened a Chase account famously in the back of an Uber. It took me less than 10 minutes. I happen to have my passport with me. Very, very easy. But there are a lot of consumers who don't want to do that. It feels too risky for them, either a brand name that they haven't heard of or just the application process digitally will put them off.
Now, Josh, before we get to the break, and perhaps to motivate somebody listening to this to potentially consider switching, Claire's touched on there how easy it is in many instances. Let's focus on the positives. There's been a lot of doom and gloom about the rates that are being offered, but let's focus on the positives. Can you tell us about some of those best providers that are around at the moment?
Yes, despite the gloomy picture I've painted, there are still some great deals out there if you're willing to shop around for them. For example, the best one-year fix on the market at the moment is from the UK branch of the Union Bank of India, which currently pays 5.4%. The best instant access account on the market is currently Kahoot's Sunny Day Saver, which pays 5.2%. But again, as we were saying before, these are brands you may not have heard of, which might put some people off, but they're very safe to use.
And then just to throw a question to you about who's eligible, I suppose, to access these accounts. I mean, can anybody access these kind of accounts?
Generally, yes, as long as you read through the terms and conditions on the account. Some of them may be restricted by, they may have like a minimum amount that you have to save. Some of them may have account fees on them, but not all of them. So it really does pay to look around, because a lot of these are just open to anyone and don't have, for example, require a prohibitive amount of money saved into them, either all at once or monthly.
So Josh, just to reiterate those numbers again then, because I think it's important for the listeners. So the best one-year fix on the market is at the UK branch of the Union Bank of India, 5.4%. Best instant access account is Kahoot's Sunny Day Saver at 5.2%. And we can find more information on the Which website, is that right?
Yeah, that's right. So we actually have guides that we update frequently on the best savings accounts and best cash ISAs that you can find on the market. So if you just go to those, they're easy to find on our website, and they will tell you the best accounts that you can get. And it will break it down by if you're interested in the best instant access, or you want a one-year fix or a longer fix. We list out the best rates on the market that you can get currently.
Perfect. And we'll also put a link to some of those in the description for today's episode as well, just to make it super, super easy for you. And Claire, really important to check as well with the FSCS here, isn't it?
Yes.
What is the FSCS? We've mentioned it before on the podcast.
It's the most unpronounceable acronym in finance. The Financial Services Compensation Scheme. So this means if it's a bank that you've never heard of and think, hang on a minute, is my money going to be safe? So long as it's accredited by the FSCS, your money, up to £85,000 per customer, is protected in the unlikely event that that bank were to fail. But that's only per bank. So in a situation like HSBC, First Direct, they're part of the same bank, so you get 85,000 between the two.
So very important. Check wherever you're putting your money, FSCS accredited. Now, after the break, we'll be looking at what the future might look like for these savings rates, and we'll find out why banks could soon be forced to offer better deals. We'll be back after this.
If you're enjoying this Which podcast, then you might also be interested in listening to other podcasts that we have to offer, like Which Shorts. Which Short is our weekly podcast that brings you a flavour of what the Which magazine has to offer, as well as our dedicated travel, gardening and tech magazines too. Each week we handpick a review, investigation or feature that was printed in one of our magazines and written by one of our award-winning writers. We then bring it to life on the podcast. So to get a taster of what Which members get in our suite of magazines, be sure to listen to Which Shorts wherever you get your podcasts.
So then, Josh, can we talk about what is being done to ensure that banks do actually offer the highest possible rates to customers?
So the major banks have had repeated warnings from both members of Parliament and the Financial Conduct Authority over the past 18 months or so. And in fact, bank bosses have even been hauled in front of the Treasury Select Committee on more than one occasion, actually, to explain why their instant access savings rates have been so bad.
And on this, we've actually done some research here at Which on the time it takes banks to pass on any changes to the base rate to savers, haven't we?
Yeah, you may be unsurprised to learn that the banks are usually much quicker to pass along a base rate cut to their customers than they are to pass along a rate rise.
So then, Claire, is this something that is, or at least should be, regulated? Which we've recently gone public in saying that in its upcoming review, the FCA, so the Financial Conduct Authority, must take decisive action against firms that have failed to provide fair value. So where are you at with this one?
Now, I don't want to be an apologist for the banks, but we have had the Consumer Duty in operation for a year now. Now, this is a set of rules that the FCA has brought out for all financial services firms where they have to demonstrate that they're doing the right thing by the consumer. It's up to them how they interpret it, but ultimately, if they can show good customer outcomes, that they've nudged us enough into making a better decision with our money, then that gets them off the hook. But if we don't do that final step of actually moving our money, taking an active decision, then that's on us. Now, all of those little bank accounts that I mentioned earlier that I've got set up with £1 or so in, just to keep an eye on what all of the different banks are doing, I've noticed in the past year that I am being nudged and pinged and cajoled a lot more into other deals, places where I could put my money where I would get a better rate, being notified with a text message rather than some kind of email that's going to be lost into the ether, saying there's a few weeks until this particular rate goes. I also think that banks are being more creative in the way that they're offering customers advantageous interest rates. There are a lot of regular saver deals. Now, they appear to be very attractive interest rate, 7%, but because you're saving monthly and it's stepped over the course of the year when you work everything out, plus if you have to pay tax on it, it's going to be less. But nevertheless, there are different ways that they can attract customers with deals, but they're not just going to pay a flat rate of interest, 5.25% on everybody's balance in their current account. If they did that, we wouldn't have any profit to speak of, and we wouldn't enjoy free in-credit banking, which you don't get in Europe or America.
Could they do more though, Claire? Could they do more?
They could always do more. They could always do more, but I think it's important to say we could always do more too. And I think anybody who invested maybe half an hour of their time after listening to this podcast, collecting up their little bits and bobs of savings and thinking, well, where could this be earning a better buck for me? They would probably be able to find something quite quickly online that would fit the bill.
Yeah, and on that point, the best thing you can do as a customer is to vote with your feet, because that's ultimately the only thing that the banks are going to pay attention to.
Now, if we loop back to the beginning, we were talking about how we're saving more at the moment, or at least those of us that are able to are saving more at the moment. Does that mean that more people need to be considering their tax-free allowance? This was mentioned by you earlier on, Claire. What sort of deals were around if we talk ISAs at the moment?
So if you're a higher rate taxpayer, that's somebody who has an income of more than £50,000 a year, certainly if you're an additional rate, which means in Scotland 75,000 or in England 125,000 plus, lucky people, you are the ones where cash ISAs really come into their own, because you're not going to have to pay tax on any savings interest earned within an ISA. So again, we've got a situation where the top rates are offered by apps, which you may or may not have heard of. Trading 212, that's actually a trading ISA, but it has a cash ISA attached, 5.2% on that one. That's topping the table. But other apps, Plum and Chip, they're also paying over 5%. With the building societies, Principality Building Society and West Bromwich Building Society, they offer cash ISAs paying over 5% at the moment, but there are restricted numbers of withdrawals that you can make on your money throughout the year. And then for the bigger names, Virgin Money and Leeds Building Society and also Moneybox, all around the 4.75% mark with the cash ISA.
Is it the case that if an ISA restricts the number of times, obviously you can make withdrawals, chances are you'll be able to access a higher rate with that? You know, if you're locking your money away or committing to locking your money away for longer, will that give you access to those higher rates?
Yes, it will. If it's a name that you're unlikely to have heard of that want to attract customers, you'll get a higher rate. If there's some kind of restriction on the rules or you've got to lock your money up for a longer period of time, you'll get a higher rate. Absolutely right. An interesting point to note on cash ISAs is that since they changed the rules in April, it's possible to have more than one with one provider. So you could have one cash ISA that's on a fix with your long-term savings and another cash ISA that's more flexible with money that you might need in an emergency. So I think that's a fantastic innovation in the market. And then the other thing to bear in mind is transferring an ISA. Now, I've written a lot about this in the FT, criticising how awful, shockingly awful, the banks can be when doing ISA transfer paperwork, because it's very pen and ink based rather than digital. I helped my husband, forced him at gunpoint to switch his cash ISA about a year and a half ago from a not very good rate to the top paying rate on the market. And it took around 6 months to go through because the branch lost the paperwork. It just sat there. You have to physically sign things and have an appointment often. Now, that is one feature of the ISA system that we really urgently need to be dragged kicking and screaming into the 21st century, please.
That is amazing that in 2024 we're still doing stuff on pen and ink, like you say.
And I have to say, after I complained, he got his money back plus compensation for the time that the money had not been earning interest in either account.
Which does show it's worth your time, isn't it? You know, if you have concerns or you've got a complaint, it is worth making that known.
If you're married to a consumer finance expert, it definitely helps.
That does always help. And finally then, can we talk about some of the other potential alternatives out there? So we've mentioned ISAs, Claire. How else can we make our money work harder?
Okay, well, I'm going to mention 2 accounts where you get a government bonus. The first one is Help to Save. Every time I mention Help to Save, which you can open if you get any kind of means-tested benefit, like universal credit, I always get an email or a social media message from at least one person who said, until you mentioned it, Claire, I'd never heard of it, so I'm going to mention it.
I don't think I've heard of it until you've literally mentioned it about 10 seconds ago.
Well, if you're on benefits, it can be a godsend. Obviously, it's hard to save. There is not very much money to go around, but Help to Save, if you can lock the money up for a certain amount of time, 2 years, if you put in £1, you will get back 50p. So it's an unbelievable rate, and it is a product that is designed for people on low incomes to help them build up money for a rainy day. So Help to Save, tell everybody in your life who needs to know about that. The second one, where you get a government bonus, is the Lifetime ISA. Now, this is a controversial product because the rules are quite complicated, but if you're under 40 and you're looking to save up to buy your first home, then you can use up to £4,000 of your ISA allowance saved into a Lifetime ISA every year, and you get a 25% bonus on that, so a maximum of £1,000 for free from the government if you're saving towards that goal. Caveats apply: you can't buy a property for more than 450k, and if you want the money back, you're unfortunately going to lose that bonus and pay a penalty, but they are worth doing some research on if that is your goal.
Plenty of food for thought there. So much that I feel like I now need to go away and do, and I need to go and sort my finances out. But Claire and Josh, thank you so much for joining us.
Thanks for having me.
Thank you for having me.
Well, a huge thanks again to Josh and Claire for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. Don't forget, if you enjoyed today's show, then please do hit subscribe to make sure you catch our new episodes as soon as they drop. And for daily money news and advice, you can find us on social media. We are at Which Money, and we're online at which.co.uk/money. And also, don't forget, we have a free money newsletter that's delivered to your inbox every Monday. And to sign up, visit which.co.uk/money newsletter. Now, this episode of the Which Money podcast was written by me, Rob Lilly-Jones, and produced and edited by James Rowe.
"2023 was momentous in the fight against fraud. It saw the passing of the Online Safety Act and the Financial Services and Markets Act. Both of these happening after years of exhaustive campaigning from us here at Which. But the battle against scams is far from over. Stay in the know and avoid falling victim to scammers by joining over 450,000 others who have signed up to our Which Scam Alerts. To sign up, head to which.co.uk/scam alert today.